Welcome back. In this video, we're going to fill out Form 4562 to calculate David's first year rental depreciation and then bring that number into Schedule E. Alright, here's Form 4562, depreciation and amortization. There are 6 parts to this form, and David only has to fill out parts 3 and 4. But here's a quick summary of what each part is for. Part 1 is for Section 179, which lets businesses immediately expense the cost of equipment like computers, machinery, vehicles, and tools. Rental buildings cannot use Section 179, so landlords usually skip this section. Part 2 is for bonus depreciation, the accelerated write-off for qualifying assets. Residential rental property does not qualify for bonus, so this section does not apply to a basic rental either. Part 3 is the MACRS depreciation. This is a section that we'll go over. Part 4 simply totals up all the depreciation from the earlier sections. Part 5 is for listed property, which means assets that can easily be used for both business and personal life, like vehicles, cameras, laptops, and cell phones. If you have listed property, the IRS makes you prove the business use percentage before you can depreciate it. David has no listed property for his rental, so we skip this entire section. Part 6 is amortization of intangible costs, such as startup costs, organizational costs, or certain improvements that aren't physical assets. Regular rental real estate does not use amortization, so this section doesn't apply here. This form tells the IRS how much of your rental building you get to write off each year. You only attach Form 4562 in the first year the rental is placed in service, or when you add a new asset that must be depreciated. If the property was placed in service in a previous year, you do not attach Form 4562 again. You just continue depreciation on Schedule E. So here are the details of David's rental property. The purchase price is $720,000. This is what he paid for the entire property, but you never enter the full price on Form 4562. The IRS only allows depreciation on the building, not the land. The land value itself is $216,000, 30% allocation. Land never depreciates, so we remove it from the calculation. Building value is $504,000. This is the depreciable basis, the portion used for depreciation. This is the number that actually goes on Form 4562. Placed in service in 2020. This is the year the rental was first available for tenants. Depreciation starts in the placed in service year. All residential rentals must use MACRS. MACRS stands for Modified Accelerated Cost Recovery System, the IRS depreciation system. It tells us how long a rental building must be depreciated and what method we use to calculate the yearly write-off. And here we use the straight line method over 27.5 years because the IRS requires all residential rental buildings to be depreciated immediately across a 27.5 year recovery period. The IRS also uses something called the mid-month convention, meaning no matter what day in the month the rental is placed in service, depreciation begins in the middle of that month. So the first year always gives you 11.5 months of depreciation, not a full 12. These rules are already printed on the IRS form. Depreciation for rentals come from an IRS table from publication 946. Because David placed his rental in service in February 2020, the IRS table gave him a 3.636% deduction for 2024. So $504,000 times 3.636% equals $18,327. If you place the rental property in service mid-year, the first year is always prorated. The exact day of the month doesn't matter because the IRS uses the mid-month convention. But you still use the full 27.5 year life for residential rentals. Only the first and last years are partial under MACRS, which is why a building never gets the full 27.5 years of complete depreciation. Alright, so here we see David fill out his name. Business activity is Schedule E rental, and the identifying number is his social security number. If it's an LLC, taxed as a partnership or S Corp or C Corp or other corporation or estate, then use the EIN number. And in part 3, we see he placed his house for rent on February 2020, and the basis for depreciation is $504,000, and the depreciation deduction is $18,327. And part 4, line 22, is the same number, $18,327. Now that we've calculated David's rental depreciation, we can move on to Schedule E. Schedule E is where landlords enter rent received and expenses of the rental property. Schedule E tells the IRS 3 things: how much rental income you collected, what rental expenses you can deduct, whether the rental produced a profit or a loss. Every rental property goes on Schedule E. If you have more than 3 rentals, you just attach extra copies of page 1. It's still one Schedule E, just repeated pages. Now before we go into the details of Schedule E, let's discuss a few things. First is the passive activity rules. Rental real estate is automatically passive unless you qualify as a real estate professional or it's a short-term rental with average stays under 7 days. Passive losses can only offset passive income. Passive losses normally can't offset W-2 income, business income, or other active money. They can only offset passive income unless you qualify for certain exceptions. So if you're involved in the rental and your income is under 100K, you can deduct up to 25K of rental losses against your W-2. Above 150K, you can't. You must use Form 8582 when you have passive losses, either new losses this year or lost carryovers from prior years. If the rental breaks even or makes a profit, you skip Form 8582. Then there's the personal use rules, the 14-day rule. Your personal use affects what you can deduct. Rule 1. Personal use of 14 days or less, or 10% of rental days. The property is treated as a full rental and you can deduct everything normally: mortgage interest, property taxes, insurance, repairs, utilities, depreciation. This is what most landlords want. Rule 2. Personal use days over 14 days and more than 10% of rental days. Now the IRS calls it a vacation home. This creates big limits. You must split expenses between rental and personal. You cannot deduct a rental loss. Depreciation gets limited. Some mortgage interest becomes non-deductible. Many people don't realize that staying too long kills their deductions. Repairs versus improvements. One of the biggest mistakes landlords make is mixing these up. Repairs you can deduct immediately. Fixing something to keep it working, replacing a faucet, fixing a broken window. Improvements are capitalized and depreciated. Items that better the property or extend its life, like new roof, new water heater, HVAC, or remodel. A simple rule is this: new roof, capitalize. Fix a shingle, deduct. Safe harbors. These IRS safe harbors let small landlords deduct things they normally couldn't, like the minimus safe harbor. Expense items up to $2,500 each. Small taxpayer safe harbor. If building less than $1 million and repairs less than 2% of basis. Routine maintenance safe harbor. If you reasonably expect maintenance every 10 years. So a safe harbor is a guarantee IRS approved shortcut that protects you from penalties or disputes. These rules save landlords thousands. Travel expenses. You can deduct travel related to managing your rental, like mileage, supply runs, meeting tenants, checking repairs. Just keep a mileage log. Security deposits. These are refundable deposits and they're not income. If you keep any amount, that portion becomes income. Insurance reimbursement is taxable income unless you spend it repairing the damage. When you convert a primary home to a rental, depreciation starts at the lower of your adjusted basis or fair market value on the conversion date. If it's a short-term rental, like an Airbnb, less than 7 days, the rental may not be considered rental real estate and may not be passive. Losses may be deductible and self-employment tax may apply. But if the activity is not rental real estate and you materially participate, the losses may be fully deductible against W-2 income, business income, etc. Material participation means you are actively involved. You're doing the work, making decisions, and running the activity yourself instead of being hands-off, and you put enough hours to satisfy one of the IRS tests. This is why Airbnb hosts try to qualify as non-passive short-term rental operators. It can create large deductible losses. This is true if your rental property involves substantial services, such as dry cleaning during stays, concierge services, daily breakfast, security services, tours, laundry for guests, Then the income becomes self-employment income, taxed on Schedule C, and subject to self-employment tax. One thing we have to make clear here is that passive activity losses are normally limited, but real estate agents have a special rule. If they qualify as real estate professionals and materially participate, their rental losses become non-passive, fully deductible with no limits. If you sell the rental property, taxes come from capital gains on appreciation and depreciation recapture at 25%. If the property was ever your primary home, Section 121 may reduce taxes. Alright, so here's what David has entered into his Schedule E. Schedule E starts with 2 quick questions about Form 1099. Box A, did you pay anyone $600 or more for services? Box B, if yes, did you file 1099s? So these 2 boxes are if David had paid somebody $600 or more, such as a handyman or a plumber, electrician, or cleaning service, landscaper, then he would need to issue a 1099 NEC for those people. In this case, he did not, so he checks no on box A, and he can leave box B blank. Alright, next is type of property. David's rental is a single family residence, so he enters 1 in box A. For fair rental days, he rented his house for the whole year. Personal use days, he has 0, because he didn't use the house for personal use. And QJV, this little box stands for qualified joint venture. It only applies when a married couple jointly owns a rental and elects to avoid filing a partnership return. So here's a list of expenses that David recorded on a spreadsheet for his rental property. So for the rest of Schedule E, we enter the property info, the rent received, the normal rental expenses, and the depreciation from Form 4562. That gives us the final rental loss of $11,637, which flows to Schedule 1 and then to Form 1040. So even though David shows $11,637 loss on taxes, it's mostly because of depreciation. Meanwhile, his tenant paid down his mortgage. The property went up in value and he reduced his taxes. So he's actually winning while reporting a loss. Alright, moving on to page 2 now of Schedule E. No section here applies to him except for Part 2, because he does have a partnership K1. Here's a summary of David's K1. David's K1 shows a $2,300 passive loss, but he isn't allowed to deduct it this year, so the IRS suspends it. That just means the loss gets carried forward and saved for a future year. So the passive loss on his K1 here, partnership, this loss is suspended because David has no passive income. It cannot be deducted. It does not reduce his rental loss. It only appears on Form 8582. We list the partnership name and EIN, but the allowed loss is 0 and nothing flows into the totals. The partnership loss does not change the rental loss at all. David also has a $650 Section 1231 gain, which goes to Form 4797, and the $165 of interest and dividends, which go to Schedule B, not Schedule E. And that's it for Schedule E. In the next video, we'll cover Partnership K1.